In this video, I am going to share something personal, the pattern I repeated for nearly 2 decades, the math that finally made me stop, and where I stand today. I want to be transparent with you from the start. I have not fully exited real estate. I am in the process, and I will tell you exactly where I stand and why. This is not a property is always wrong video. It is an honest account of my own experience, my own numbers, and what I would do differently. If you are an NRI holding property in India or thinking about buying, I think there is something in this story for you. Let's get into it. It is 2006. I am in Abu Dhabi and have just bought my first investment property in India, a commercial property. It felt like the right move. Property in India was appreciating strongly. In the Gulf NRI community, owning property back home was a mark of having made it. My family approved. I approved. But here is what is interesting. With the money that was left over after that purchase, I also made my very first equity investment in an Indian mutual fund. Not a large amount, the leftover, almost an afterthought. That afterthought, it turns out to be the best decision that I have ever made. In the months and years that followed, I invested in equity mutual funds every month, disciplined, systematic, and the returns were very good, consistently in the range of 17 to 18% annualized. My portfolio was growing, but every time the portfolio reached a significant size, every time I had accumulated a meaningful corpus, I would sell it and buy a property, commercial, residential, land. I repeated this cycle multiple times. Invest in equity, grow the portfolio, sell, buy property. Here is what puzzled me for years. Every time I bought a property, every single time, I did not feel particularly happy. You would expect some satisfaction, some sense of achievement, but it was not really there. And then one day I understood it was not an achievement. It was a transfer. The achievement had already happened over the previous 2 or 3 years through disciplined investing, through compounding returns of 17 to 18%. The wealth had already been created. Buying the property was just moving that wealth from one container to another. I was not adding to my net worth. I was reorganizing it, selling one asset and buying another. The happiness I actually felt, the real satisfaction was watching my equity portfolio grow, seeing the returns, seeing the number increase month by month. That was the achievement. I just did not recognize it at the time because it was on a screen and not something I could visit or point to. The moment that truly changed my perspective was the day I did one calculation. I looked at all the money I had put into equity mutual fund over the years, the amounts I had accumulated and then sold to buy each property. And I asked one question: what would that money be worth today if I had simply never sold? The answer was a shocker. I will not give you my specific number because that is not the point. The point is the gap between what my equity portfolio would have been compounding at 17 to 18% over 15 to 18 years, and the actual value of the properties I bought was very significant, more than I had expected. This is the opportunity cost that almost no NRI calculates. We look at the property price, we look at the appreciation, but we almost never ask, what did I give up to buy this? Now, let us look at the rental yield reality because this is where the numbers became difficult to ignore. In India, a residential apartment gives you approximately 2.5% rental yield. A commercial property gives you a maximum of 6% in good conditions with good tenants in a good location. Land gives you nothing by way of income and carries its own serious risk if you are not present to manage it. In the UAE, residential property gives you a maximum of 6% yield. Against that, Indian equity mutual funds have delivered approximately 15% over long periods. Global equity markets, 10% or above, with the added benefit of returns in dollar or euros that do not suffer the same currency depreciation as rupee denominated assets. I'm happy to take less than 15% for the peace of mind equity brings. Even 10% is a trade I would make without hesitation. And here is one fact I want you to sit with. Approximately 66% of all civil court cases in India relate to land and property disputes, a figure documented by DAKSH India, an independent legal research organization. not 6%, 66. Two out of every three civil cases in India are about property, land encroachment, title disputes, tenancy conflicts, inheritance problems. And the average time to fully resolve a property dispute through the Indian court system is estimated at 20 years. If you own property in India as an NRI and you are not physically present, you are exposed to this system. And in my experience, even being present does not always protect you. Remember, we calculate property appreciation. We almost never calculate the opportunity cost of what we gave up to buy it. Those are two very different numbers. I do not want to speak in abstractions. Let me tell you what I actually went through. I have had a flat vacated from squatters twice, not once, twice. That process, the legal steps, the coordination from thousands of kilometers away here in the UAE, the time, the stress, the helplessness of dealing with a situation is not something you forget. I have dealt with a land issue where some very undesirable elements were involved. I will not go into details, but resolving it was not straightforward, and the experience reminded me very clearly of what it means to own an asset you cannot physically protect. And I have had a commercial property that remained vacant for an extended period and then faced real difficulty when I wanted to sell it. It is one thing to own an asset, but converting it back to cash is far harder. In each of those situations, I felt genuinely helpless. You are here in the UAE, your asset is thousands of kilometers away in India, and the control you thought you had is largely an illusion. That feeling, not having control over something you own, is very different from watching equity markets move up and down. Market movements are normal. They are expected. You understand what is happening and why. A correction is uncomfortable, but it is not a crisis. A squatter, a land dispute, a vacant property that will not sell. Those are situations where you have limited options and very limited ability to act quickly. I have not had a single bad experience with equity in close to 20 years of investing. Not one. The market has gone up and down, and over time, through every correction and every period of uncertainty, the direction has been upward. Remember, market volatility is manageable. Not having control over your own asset is a different feeling entirely. I'm also not saying real estate is a bad asset class for everyone. If you have fully paid off property generating consistent income with low management burden and the numbers genuinely work, that is a valid position. But know the real numbers, know the rental yield, know the opportunity cost. For NRIs based in the UAE, the alternatives are concrete. On the Indian side, a well run diversified equity mutual fund through the direct plan route. On the global side, a portfolio of Ireland domiciled ETFs structured to avoid US state tax exposure for non US persons. I will cover both of these in dedicated videos. I'm not asking you to do what I did. I'm asking you to do one thing I wish I had done much earlier. Sit down and calculate your actual return, not the headline appreciation, the real net currency adjusted, management cost included, opportunity cost aware number. I have done this calculation for my own portfolio. The result was what led to this decision. I'm confident that once you see your real number, not the number you assumed, you will have much greater clarity about your next move. 28 years in the Gulf, I arrived believing what most of us believe, that property is the foundation of wealth, that what you can see and touch is real, and what is on the screen is temporary. My experience taught me the opposite. Equity mutual funds gave me return north of 15% annually over long periods. They gave me complete liquidity. They gave me the ability to invest every month starting from small amounts. They gave me full transparency into what I own. And they have never once required me to deal with the squatter, a vacant property, a land dispute, or a sleepless night about something happening to an asset I cannot physically see or protect. I will take less than 15% for that peace of mind. And in my experience, I do not have to. And if you are curious about the mechanics of actually exiting property in India as an NRI, the TDS, the capital gains, the repatriation process, I'm planning a dedicated video of that. Subscribe so you do not miss it. If this video gave you something to think about, please like it. It genuinely helps this channel reach more NRIs who are asking these questions and not getting honest answers elsewhere. Subscribe to Investing with Siddick. Every video on this channel is built specifically for NRIs in the UAE and Gulf, covering equity mutual funds, global ETFs, NRI taxation, and how to build wealth that works across borders and currencies. In the comments, are you holding property in India right now? Have you ever done the real calculation of your returns? Tell me below. I read every comment. This video is for educational purposes only. It is based on my personal experience and does not constitute financial advice. Please consult a qualified financial advisor before making any investment decisions. See you in the next one.